Real quick, before we get into anything, I need you to look at this number. 18. That's how many years it takes for the real estate market to run one full cycle. One peak, one bottom, one recovery, back to a peak. 18 years, like clockwork going back to the 1800s. The last peak? 2006, right before everything fell apart. The one before that? 1989, same story. And the current peak, right now in 2026, we're sitting at the top of that cycle again. So here's the question. If you know you're at the top of an 18-year cycle and you've got $80,000 saved up, do you buy a rental property right now? Or do you do something else with that money? That's what this video is about, and the answer is not what most people think. Alright, let's set this up properly. Two people, same age, 32, same savings, $80,000. Both trying to build wealth, both making a big financial move right now in 2026. First person is Dylan. He's been saving for years, done his research, and he's about to put that $80,000 into a down payment on a rental property. He's excited, he's run the numbers, he thinks he's making a smart move. Second person is Priya. She looked at the same options, but she's going a different route. She's investing that $80,000 into index funds. But here's the thing, she's stacking it with a set of tax advantages from new legislation that most people still don't know exist. And those tax advantages are going to change the math in a pretty serious way. Same money, same starting point. But by the time they're both 42, there's going to be a six-figure gap between them. And it all comes down to one specific number, a threshold, that we're going to reveal at the end. Let's walk through both sides of this. And let's start with Dylan because honestly, his case is pretty convincing on the surface. Dylan's buying a $400,000 rental property. He puts 20% down, that's his $80,000. He finances the remaining $320,000 at 6.8%, which is pretty much where rates are sitting right now in mid-2026. His monthly mortgage payment comes out to about $2,090. He rents the place out for $2,400 a month. On paper, that's a positive $310 every single month, cash in his pocket. But here's the part that really gets him excited, and honestly, it's the part that makes real estate so attractive in the first place. It's the leverage. He put in $80,000, but he controls a $400,000 asset. If that property goes up in value at the historical average of about 4% a year, in 10 years it's worth roughly $592,000. That's a gain of almost $200,000 on an $80,000 investment. A 240% return. Try getting that from a savings account. And that's not even counting the mortgage paydown. Every month, his tenant is basically paying off a chunk of his loan. So his equity builds two ways, appreciation and paydown. Simultaneously. This is why people love real estate, and he's not wrong to love it. Okay, so where does the math start to crack? First thing, and this is the big one, he's buying at the peak of the 18-year cycle. I know I said that in the hook, but let's actually sit with it. The last two peaks were 1989 and 2006. What happened right after 1989? A real estate stagnation that lasted 7 years in most markets. What happened right after 2006? You know what happened. 2008 was one of the worst housing crashes in American history. Now, is 2026 going to look exactly like 2008? Probably not. But the cycle is the cycle, and buying at the peak of it means his appreciation assumptions, that 4% per year, could easily be zero or even negative for the first 3 to 5 years of his hold. That changes everything downstream. Second thing, there's a $930 billion problem in commercial real estate right now. $930 billion in commercial real estate loans are maturing in 2026. That's 3 times the 20-year average. Banks that lent money against inflated 2021 valuations are now dealing with assets that are worth less than the loans on them. That creates distressed sales, it tightens lending standards, and it pulls capital out of real estate broadly, residential included. Third thing, the lock-in effect. Millions of people bought homes between 2020 and 2022 at rates below 3.5%. Those people are not selling. They can't afford to trade their 3% mortgage for a 6.8% mortgage on a new house. So the supply of homes for sale is artificially low, which means he's competing for whatever's left and paying full price for it. Now let's go back to that $310 per month positive cash flow, because that number is doing a lot of heavy lifting in his spreadsheet, and it's not the whole story. Property management. If he's not self-managing, and most people aren't, because managing a rental is basically a part-time job, that's 8 to 10% of monthly rent going to a management company. Call it $200 a month. Vacancy. Nobody has a tenant 100% of the time. Industry standard is to budget 8% vacancy. On a $2,400 rent, that's $192 a month, averaged out over time. Maintenance and repairs. The rule of thumb is 1% of the property value per year. On a $400,000 house, that's $4,000 a year, or $333 a month. And that's just the average. The year the HVAC dies, it's $8,000. Insurance and property tax. Depending on the market, you're probably looking at $350 to $400 a month combined. Add that up. Property management, vacancy, maintenance, insurance, tax. You're looking at roughly $1,100 a month in expenses on top of the mortgage. Dylan's $2,400 rent minus his $2,090 mortgage minus $1,100 in operating expenses equals negative $790 a month. He's not making $310 a month. He's losing almost $800 a month. Over 10 years, that's $93,000 out of pocket just on operations. Before he touches a single major repair, before a bad tenant, before a vacancy that lasts 3 months instead of 1. So he needs that property to appreciate significantly, just to cover what he's spending to hold it. And he's betting on that appreciation at the peak of an 18-year cycle, with a $930 billion debt wall hanging over the broader real estate market. That's not a disaster, but it's a very different risk profile than the headline math suggests. All right, let's talk about Priya. She takes that same $80,000 and puts it into a broad market index fund, total market ETF, expense ratio of 0.03%. Nothing fancy, nothing exotic, just buying the whole market. Now, most videos at this point would just say 10% per year. Here's what the compounding math looks like. And that number, 10%, is the long-run average for the S&P 500. It's real. But in 2026 specifically, it's not the whole picture. Because we're in a weird spot right now. The Buffett indicator, which measures total stock market value relative to GDP, is sitting at 213%. To put that in perspective, the long-run average is around 100%. We're more than double that. The Shiller-Cape ratio is approaching historic peaks, and a recession signal called the Vicious Cycle Index, which is more accurate than the old SOM rule because it factors in workforce participation, not just unemployment, was triggered in January 2026. So she's not assuming 10% every single year from day one. She's planning for what's actually realistic, and there's a framework for that. It's called the 10-5-3 rule. The 10-5-3 rule is simple. For equities, stocks, index funds, the realistic long-run baseline is 10% per year. For bonds and debt instruments, it's 5%. For cash savings accounts, 3%. But here's the part people skip. That 10% equity return doesn't come in smooth 10% increments every year. It comes in a cycle. There's what people call the irritation phase, where your returns are basically flat or slightly negative and you feel like nothing is working. Then there's the panic phase, where markets actually drop and people sell at the worst possible time. And then there's the recovery phase, where the bulk of the gains happen and the people who held on get rewarded big. Most people blow up their investing by selling during the panic phase. The 10-5-3 rule helps you set realistic expectations so you don't. She knows the rule. She's not panicking when her portfolio is down 15% in year 2. She knows that's part of the cycle, and she's buying more shares at a discount. But here's where it gets really interesting. She has access to something that didn't exist before 2025, and it's the reason her math is going to separate from his in a way that's hard to close. In July 2025, a piece of legislation called the One Big Beautiful Bill was signed into law, and it created a set of above-the-line deductions, meaning they reduce your taxable income even if you don't itemize. Most people have no idea these exist. She does, and she's stacking all 3 of them. Layer 1. The overtime deduction. She works overtime. Under the new law, the premium portion of overtime pay, up to $12,500 for a single filer, is now deductible. That means money that used to go straight to the IRS now stays in her paycheck. Every dollar of it goes into her index fund. Let's say she's in the 22% tax bracket. On $12,500 of overtime deduction, she's keeping roughly $2,750 that she would have otherwise paid in federal income tax per year, just from that one provision. Layer 2. The Trump account. This is a new child savings vehicle created by the OBBB for kids born between 2025 and 2028. The federal government drops $1,000 into it automatically. Parents can add up to $5,000 a year tax-deferred, and the fund tracks a U.S. index like the S&P 500. Her daughter was born in 2025. That account is open. She maxes it out every year. If that $1,000 federal seed plus her $5,000 annual contributions compound at 10% for 60 years, by the time her daughter is 62, that account is worth over $1 million. And she barely had to think about it. Layer 3. The SALT cap. She lives in California. Before the OBBB, the state and local tax deduction was capped at $10,000. The OBBB raised that cap to $40,000. That's a $30,000 increase in what she can deduct on her federal taxes. In a high-tax state like California, that translates to real money back in her pocket. And it all gets reinvested. Stack those 3 layers on top of the base index fund returns, and she isn't just investing $80,000. She's effectively turbocharging it with tax savings that he can't access through his rental property. Real estate has tax advantages too. Depreciation, mortgage interest, but they don't stack like this, and they don't apply when your property is cash flow negative. Here's one more thing working in her favor, and this is the concept I think is most underrated in personal finance. Compounding has a threshold. A point where the math fundamentally changes. When you have $10,000 invested at 8%, you earn $800 that year. $800 that's less than most people save in a month. It barely feels real. But when you have $100,000 invested at 8%, you earn $8,000 that year. That's more than many people's monthly take-home pay. Your money is now generating returns that exceed what most people can manually add to their savings. That's the threshold. We call it compounding escape velocity, and it kicks in somewhere around $50,000 to $100,000 in invested assets. Once you cross it, the math starts working with you instead of for you. Before you cross it, you're grinding. After you cross it, the portfolio does a significant chunk of the heavy lifting. Her $80,000 starting investment puts her at the edge of that threshold on day one. With her OBBB contributions added on top, she's going to cross it within the first 18 months. After that, the growth accelerates. His $80,000 went into a down payment. His liquid investable portfolio is essentially zero. He's starting the compounding clock from scratch while also bleeding $800 a month on operations. Okay, same starting point, same year, same $80,000. 10 years out. Let's run his numbers first. His property appreciates at 4% per year. After 10 years, it's worth $592,000. His remaining mortgage balance at that point is roughly $267,000. So his gross equity position is $592,000 minus $267,000. That's $325,000. Now subtract the cumulative cash he spent out of pocket, $790 a month in net operating losses times 120 months. That's $94,800 he's put into this thing on top of his down payment. Net real position after 10 years? About $230,000 in equity after accounting for what it actually cost him to hold it. His actual gain on the $80,000 he started with, after all costs, is about $150,000. A 188% total return over 10 years. Not bad. But, and this is the important but, that number assumes the 4% appreciation rate held the entire time. Remember, he bought at the peak of the 18-year cycle. In a realistic scenario where appreciation is flat or slightly negative for the first 5 years, which is what happened after the 1989 and 2006 peaks, His equity position in year 5 is basically the same as day 1. But he's already spent $47,000 out of pocket to hold it. Now let's run her numbers. $80,000 in a total market index fund at 10% average annual return over 10 years gives her roughly $207,000. She's also adding to it every year from her OBBB overtime tax savings, about $2,750 annually from the overtime deduction alone. That stack, invested at 10%, adds around $43,000 over the decade. The SALT cap benefit, call it $2,500 to $3,000 a year reinvested, adds another $38,000. Total portfolio after 10 years, roughly $288,000. Net gain on her original $80,000, about $208,000, a 260% total return. The gap is about $58,000 in her favor under normal appreciation assumptions. But under a cycle peak correction scenario where his property is flat for the first 5 years, that gap jumps to over $100,000. And it widens every year after that because her compounding base keeps growing while his equity is still catching up. That gap wasn't created by her being smarter. It wasn't created by some complex strategy. It was created by 3 things. 1. She avoided locking $80,000 into a depreciating risk asset at the peak of an 18-year cycle. 2. She used tax law that most people don't know exists to accelerate her contributions without earning more money. 3. She crossed the compounding escape velocity threshold faster because her capital stayed liquid and invested. So what's the specific threshold I mentioned at the top? Here it is. If your investable capital is below $50,000, real estate's leverage effect is proportionally stronger than index fund compounding. When you're working with a small base, compounding is too slow to feel real. Leverage fixes that. You control a $300,000 or $400,000 asset with $60,000 down, and the gains are amplified. But once you're above $50,000 in invested liquid assets, the math starts to flip. Compounding on $50,000 at 10% is $5,000 a year. On $100,000, it's $10,000 a year. You're generating returns that start to exceed what most people can manually save and invest. At that point, leverage is no longer the differentiator. Tax efficiency and compound momentum become the differentiator. They both started with $80,000, both above the threshold, but he took his $80,000 and converted it into an illiquid asset with negative cash flow and cyclical timing risk. His compounding clock is at 0. Her compounding clock started the day she invested. That difference in compounding start date, compounded over 10 years at a meaningful rate, is where the gap comes from. Now look, real estate is going to recover. It always does. The cycle runs 18 years, which means the next trough, the optimal buy window, is likely somewhere between 2028 and 2032. There are already predictions that mortgage rates are going to pull back towards 6% by the end of 2026, which could create what economists are calling a dead cat bounce, a short-term burst in buyer activity as people who've been locked out finally get in. But that bounce isn't the same as a full recovery. The real opportunity in real estate, for someone who has the patience, is probably 2 to 4 years from now, when some of the distressed commercial real estate properties start coming to market, when the cycle has bottomed out, when rates have stabilized. That's when you get the leverage working in your favor without the cyclical headwind working against you. He might still come out fine. Real estate is not a bad investment, but the timing, the cash flow reality, and the 2026 specific macro environment mean his path to wealth is significantly harder than his spreadsheet suggested when he ran the headline numbers. So, what's the actual takeaway here? It's not real estate is bad. Real estate has built more wealth for more people than almost any other asset class in history. And it's not stocks always win. Stocks can get cut in half in a bad year and take 3 years to recover. The real takeaway is this. The math on your investments depends entirely on where you are in the cycle, what tax tools are currently available to you, and whether your capital base is above or below the compounding escape velocity threshold. Most people only look at one of those 3 things. Usually the first one, is this a good asset? But they skip the cycle timing and the tax layer completely. Priya didn't win because she's smarter than Dylan. She won because she ran all three dimensions of the math, not just the headline number. Real quick, let's recap the OBBB stack because I think this is the most underused set of tools in personal finance right now. The overtime deduction. Up to $12,500 a year for single filers, $25,000 for married filing jointly, is now deductible above the line. That means if you work overtime, a portion of it is effectively tax-free at the federal level. The phase-out starts at $150,000 in income. So this hits hardest for people in the $60,000 to $150,000 range, which is most of the working middle class. The Trump account. If you have a kid born between 2025 and 2028, this account is available to you. $1,000 federal seed, $5,000 annual limit, tax-deferred, S&P 500 tracking. Open it, max it, and don't touch it. The compounding math over 60 years is genuinely hard to believe. The SALT cap expansion. If you're in California, New York, New Jersey, or any other high-tax state, the deduction cap went from $10,000 to $40,000. This one has a sunset in 2030, so you've got about 4 years to take full advantage of it before it potentially reverts. Stack all three of those on top of a low-cost index fund strategy, and you're effectively investing more money per year without earning more money per year. The tax system is doing a chunk of your savings work for you. The whole point of this channel is to run the full math, not the headline number, not the motivational version, the actual numbers with the actual costs and the actual cycle timing. He didn't know he was buying at the peak of an 18-year cycle with a negative cash flow property while skipping a set of tax tools that could have compounded his returns by a meaningful margin over the same decade. That's the difference between the math they show you and the math that actually matters. If this breakdown changed how you're thinking about the real estate versus stocks question for 2026, subscribe, drop a comment below. Dylan or Priya, which path would you take right now? And if you want to go deeper on any one of those OBBB provisions, specifically how the overtime deduction works mechanically, because there's a calculation most people are getting wrong, that video is right here. It's worth watching before you file or plan for next year. I'll see you in the next one. I'm not a financial advisor or tax professional. This video is for educational purposes only. Always consult a qualified CPA or tax attorney before making any decisions based on what you've seen here.